As Tyler mentioned, Moody's cutting the ratings of 10 U.S. banks and putting some big ones on downgrade watch. Leslie Picker is here with more. And these are, we'd call them kind of the big regionals and maybe some of the trust banks. Is that right?
That's exactly right. And, there were 27 ratings actions in all along this same theme. Interest rates likely to remain higher for longer amid quantitative tightening, exacerbating a mismatch between assets, loans, and liabilities, deposits. Risks associated with monetary policy have been pressuring profitability, and regulators are layering new potential rules on mid-sized banks that could cause them to ultimately pull back on loan making, which could, of course, affect profitability as well. And then there's that canary known as commercial real estate. We talk about it all the time on the show, particularly office buildings in certain pockets of the country that have plummeted in value due to the prevalence of remote work. Moodys said Q2 earnings releases actually informed the ratings actions, which is interesting because prior to today's move, the regional bank ETF, the KRE, was up a whopping 20% since quarter end. And the major issues that the ratings agency flagged have been pretty well telegraphed since Moody's prior round of actions for the regionals in the spring. Even as equity investors have been willing to look past some of the major industry headwinds, bond and options investors have not been quite as sanguine. As New Edge's Ben Emons notes, regional bank spreads remain above high-yield spreads, and options on a handful of small-cap regionals imply a 15% chance of FDIC seizure. So perhaps today's move by Moody's is serving as a reminder that even though it's been a quiet summer on the regional banking front, we may not be out of the woods quite yet, although there's a lot of debate over whether the worst is behind us or if there's still more dominoes to fall.
Why now, and were these downgrades in any way anticipated, or could they have been anticipated?
They weren't anticipated by the market. That's very clear. You talk to market participants, most analysts, nobody really expected this to come today. Why now? We've seen the bulk of the earnings releases from the regionals at this point in time. So I think they were able to, collate a bunch of the balance sheets, income statements, and draw some conclusions based on that, that informed their ratings action.
Mm-hmm. Mm-hmm. Yeah, that said, if this had happened a couple of months ago, can you imagine the impact? Certainly if it had happened back in the thick of, the days when we were most concerned about the banks, it could have really sparked. And not to minimize the moves. WaFd, we speak to Brent Beardall, they're down 5% today. But now that we kind of know that this is priced in, the real question to me is not so much about Moody's, and it's really just about economic activity, 6 or 12 months out, when they're clearly retrenching under pressure and facing some future losses and problems as described.
That's it. And then, of course, what's going on with the 10-year and all the volatility on the rates picture. You've got quantitative tightening, you've got all this issuance, and then you've got monetary policy in Japan that's also impacting the various flows. And so all of that plays into what you're seeing with banks, whether it pertains to their deposits, whether it pertains to, their asset markings. And then there's just an overall confidence issue that remains in the balance as well. That was one thing that Moody's pointed out in their notes, this idea that, it's unclear just kind of the way that these things are accounted for, what the level of capital is. You saw that, of course, with Silicon Valley Bank, how much capital you could have in order to fulfill some sort of bank run. Nothing has changed in terms of just the technicalities that caused the Silicon Valley Bank run. They had definitely idiosyncratic issues as it pertained to their customer base, concentration levels, uninsured deposits. Those are very specific situations. But the sheer amount of deposits that fled, nothing's really changed in terms of the picture that would keep deposits in-house anywhere else.
True.
Yeah. All right, Leslie, thank you very much. Good to be with you.